Principles of Accounting, Chapter 23. So in Chapter 23, we talk about budgeting. So budgeting is part of our planning process. So we use it to coordinate and schedule and make our plans for the year. We also use it in order to make decisions about the upcoming year and what various things we might need. And we use it for performance evaluation. So we compare actual results to budgeted results to see how well people did at meeting their goals. When we look at budgeting, we're going to look at this example of this Network Technologies Incorporated. So they had a very strong fourth quarter, and we're going to look at some of their information. So the first thing that we're going to look at is their profitability measures. So we have their gross profit margin, their net income percentage, return on equity, and return on assets. And we're looking at those as compared to industry standards. So they're very profitable, yet they are cash poor. So we'll see that when we look at the next information. So their current ratio and their quick ratio are much lower than industry average. So even though they appear to be profitable, they have severe cash flow problems. So their liquidity measures are well below industry standards. So their accounts receivable turnover is very low. And so they need to figure out how they are going to fix their cash management problem and their cash flows problem. So they need to, so we have the information about their fourth quarter of 2017 is that we dispersed large sums of cash to manufactured goods available for sale. So all of their cash was tied up in inventories. As those inventories were sold, they developed accounts receivable and they weren't receiving cash from their accounts receivable. So they have a major cash management problem in that their cash is all tied up in either inventories or in accounts receivable, and they need to figure what to do in order to free up that cash and have it available for their liabilities. So when we're looking at their operating cycle, and the operating cycle is looking at from when we use cash to purchase merchandise or inventory or anything until we receive cash from accounts receivable. So right now our average accounts receivables payment is 81 days and our inventories are tied up for 160 days. Therefore, our operating cycle is 247 days. That's almost a year. So this gives us negative cash flows from operations because all of our cash is in inventory and accounts receivable, and it isn't available to us to pay for our accounts payable and salaries and other things that we need. So we need to look at budgeting holistically as having this plan for financial and operation goals for the organization. Everyone benefits from planning and budgeting. So all economic entities, business, governmental, universities, churches, and individuals engage in some form of budgeting. Some governmental agencies, universities, and churches or other nonprofit organizations have very defined budget cycles. And then businesses, what we're looking at for this next chapter are what businesses go through for budgeting. So why do we budget? It's just a planning mechanism. So it gives us better information about what we need to do to coordinate activities, to create schedules, to plan for cash expenditures. And as I said before, that performance evaluation measure where we come back and look at our manager's performance based on how well they met their budgeted targets. When we're looking at budgeting amounts, so this chapter talks about two basic philosophies for budgeting. One is the behavioral approach, and the other one is the total quality management or TQM approach. So first we're going to talk about the behavioral approach because it's the most widely used in budgeting today. And so looking at the behavioral approach, we look at how the company behaves. We set budgeted amounts at reasonable and achievable goals. We use historical information to build our future budget. So how has the company behaved in the past can predict how they're going to behave in the future. Um, Failure to stay within the budget is an unacceptable level of performance, and any department that operates efficiently should be able to exceed any budget that we create. The other approach is total quality management, or TQM. So under total quality management, we are looking to get better and better every year. So we're always striving for improvement, continuous improvement. So we're looking at eliminating all of inefficiencies and non-value added activities. We're looking for value chain analysis and streamlining that value chain and removing as many non-value added activities as we possibly can. This is also sometimes called the Kaizen approach to budgeting, and Kaizen means continuous improvement. Okay. So how do we select and use a budgeting approach? Well, we should participate actively in the budget process. In fact, the more people that we have participating actively in the budgeting process, the more accurate and well-defined our budgets are. Usually the people that work in our departments have the best information about how those departments are performing on a day-to-day basis. We also have to understand what the purpose of our budget and any philosophy underlying the development of budgeted amounts. And some of that philosophy comes under, if we set goals too high, are we incentivizing our employees or discouraging them because they've been set so high that they're not achievable? Or if we tie performance to budget, is it tied in such a way that we're actually encouraging people to commit fraud in order to hit their budget? So that's some of the things that we have to think about when we're creating these budgets, is that we want attainable budgets that are helping the company grow, but at the same point aren't so goal oriented that people can't meet those goals or they're encouraged to commit fraud to meet those goals. So we look at the different budgeted amounts. So if we have the behavioral approach, we have that highly efficient units usually exceed the budgeted level of performance. And in total quality management, even our best units or departments can fall short of budget standards because under total quality management, we are setting very tight, rigid goals to improve every single time we create a budget. So we're cutting costs every time we improve a budget. And it does get to a point where we're already running as efficiently as humanly possible, and we just cannot get any better at that budgeting approach, no matter how hard we try. There is a level that we hit that we can no longer hit improvement just because of human and machine limitations. Our budgeting period usually covers one entire year. So our operating and financial budgets generally cover one fiscal year, and then we can divide those budgets into quarters and months. A rolling budget is a budget that we have already created, and then whenever we start one month, we add that month to the end of the year. So as soon as So for example, as soon as we get to the end of October 2020, we would have October and November 2021 added on to the end of the budget. So we're always looking at the budget every month, and we're forecasting out 12 months at any given time. So what are the components of our master budget? So our master budget includes the operating budget and financial budgets. The operating budgets are what we're going to be looking at most in this chapter. So the operating budgets, we start with the sales budget. From the sales budget, we make our production budgets. If we are not a manufacturing company, instead of a production budget, we would have a merchandising purchases budget if we sold merchandise, and if we were a service company, we would just have plans for direct labor and overhead for our services. Then we have our cost of goods manufactured and sold budget. We move into our selling and administrative expense budget, and then we create a cash budget. Our financial budgets include our budgeted financial statements and our capital expenditures budget. We're going to talk about our capital expenditures budget in chapter 26. So if we look at this graphic, we have our strategic plan, then our operating budgets, and then our financial budgets. Financial budgets with the budgeted financial statements, those financial statements are also called pro forma financial statements. So what we're going to focus on in this chapter are operating budgets. When we're creating a master budget, we always start with the sales forecast. We need to know what the marketing team forecasts for sales before we can make any other plans about how many items we need to produce or how much merchandise inventory we need to have on hand, or if we're a service organization, how we need to schedule to meet the services for our sales forecast. So when we're looking at creating the budget, we're going to look at this example for this technology company that we were talking about in the chapter. So we're going to help them try to avoid the cash flow problems they had in the previous year. Their sales are expected to increase, but we're going to cut back on production because we currently have a lot of inventory that we have on hand. We have no work in process inventory as of January 1st, and no capital expenditures are planned for 2018. So we start with our beginning balance sheet. And we have a lot of information here about our beginning balance sheet, what we have in receivables and in our inventory. And we're going to use some of this information to create our budget. We'll start that on the next video.